Hello, this is Pharma College Hawassa Campus School of Postgraduate Studies, Department of Masters of Business Administration. This presentation is by Ainishat Aganyo. The first chapter is an overview of financial management. This chapter has three objectives. The first objective is what is finance and what is the relationship between economics and accounting. Describe the managerial finance functions and the role of financial managers, explain the goal of firm and corporate governance, and what is the issue of agency problem, or what are the causes of agency problem. The first chapter, what is finance? Finance can be defined as the art and science of managing money. Money is refers to a medium of exchange. Under the finance, virtually all individuals and organizations earn or raise money and spend or invest money. So this is the concept of finance in short. In broad term, what is finance? Finance is concerned with the processes. In finance, there are different kinds of processes. This is the circulation of money. In finance is concerned with the institutions. Finance is a market. When we say the finance is concerned with the market, we buy and selling of different financial assets in the finance environment. So finance is concerned with the market. Finance is concerned with also the instruments involved in transfer of money among individuals, businesses, and governments. So the next objective is what is the managerial finance functions? As a firm grows, separate finance functions evaluate under the chief executive officers. Under the chief finance officers are the treasurers and the controllers. The treasurers and the chief financial manager is responsible for financial activities such as financial planning, fundraising, making capital expenditure decisions, managing of cash. The inflow and outflow of cash will be managing by the managerial finance functions, managing credit activities, managing pension fund, managing foreign exchange. These all are the managerial finance functions that are responsible by the chief finance officer. The controller or the chief accountant handle the accounting activities. Financials accounting, cost accounting, tax management. These all are handling by the controllers or the chief accountants. When we say this is a financial accounting, is emphasizing of it is to preparing of financial statement and how to recording of the financial activities. This is the handling by the chief accountant in financial accounting. When it is a cost accounting, it is to planning of different cost activities by the chief accountant. So it is to minimizing of costs under the chief accountant. The other one, tax management, it's also handled by the controller. The managerial finance functions others is the treasurers focus more on external activities. It is to preparing of the financial statement. It is to providing for the investors, for the government, and so on. So the treasurer focuses on external activity, whereas the controller focuses more on the internal activities. The other objective is what is the relationship between financial management to other disciplinary like to economics and accounting. So accounting is a field of finance is closely related to the economics. The financial managers must understand the economic framework and be alert to economic activities and policies. Be able to use economic theories as a guidelines for efficient business operations. For example, what is the relationship between supply and demand? What is the theory of supplies and demand? This is the concept of the economics. So the financial management is closely related to what? The course of economic. And what are the strategy of the profit maximizations? In microeconomics, the objective of the firm is profit maximization. So what is this strategy? This is a concept of the economics. So the financial management and economics is closely related to each other. The other one, the relationship of financial management to accounting. The treasurer's and the controller's activities are closely related. There are two basic differences between finance and accounting. So we come to here. The first difference between the financial management and accounting relates to the emphasis on cash flow. So when we say the cash flow is the inflow and the outflow of cash, based on this, they have basic differences. The first one is the accountant's primary function is preparing of financial statement. This preparation is based on the accrual basis of accounting. As you know, in the undergraduate courses, there are three bases of accounting: accrual basis of accounting, cash basis of accounting, and modifiers or mixed basis of accounting. Among of these type of basis of accounting, the accountants focus on the accrual basis of accounting. When the firm is sell on account or on cash, the revenue should be recognized. This concept is the accrual basis of accounting. The financial managers primary emphasizing on the cash flow. So when come to here, the financial managers among of that type of basis of accounting, it is to focusing of the cash basis of accounting, which means the cash basis of accounting is indicating that, or it tells us when a firm is should be recognizing of the revenue. When the cash is received, the revenue should be what? Recognized. So it's depending of the inflow and the outflow of cash. The financial managers is more emphasizing of this, the cash basis of accounting. The other one, the financial manager is concerned with maintaining the firm's solvency by preparing of the cash budget. The financial manager uses of what? The cash basis to recognize the revenue and what? The expenses. The accountant may report profit for the periods on the accrual basis, but the financial managers may face the negative or the net cash flow. The net cash flow is indicating that it is the difference between, don't forget here, net cash flow means the difference between the outflow, the inflow of cash and the outflow of cash. So the financial managers should be maintaining of or to avoiding of this negative net cash flow. When the outflow of cash increased, the inflow of cash is decreased, the net cash flow is negative. So this is maintained by the financial managers. With regard to decision making, the accountant devote most of their attention the collections and presentations of the financials data and to prepare or to handling of the financials data. The financial managers that preparing of by the accountants, evaluating of the financial statement and developing of other data, and lastly making of decisions. So what are the role of the financial managers? The role of the financial managers: capital budget decisions, financing decisions, that which means what is the best type of financing system? The debt financing, equity financing, or mixing? Which one is the best of financing decision? This is also the role of the financial managers. The other one is asset management decisions, also the role of the financial managers. How do we manage existing asset efficiently, effectively? Greater emphasis on the current asset, because the current asset is the operation period is less than 1 year. The other objective or the last objective of this chapter is the goal of the firm. In microeconomics, the objective of or the goal of the firm is profit maximization. But when counting in the financial management, it's based on the time, based on the return. The goal of the financial management or the goal of the firm is under the financial management wealth maximizations. Wealth maximizations. So this all about the first chapters of under financial management. Thank you for your attention.